did you? Anything you want.
China to kill US dollar with its hidden gold reserves? China's economy is showing strains from the prolonged tariff war with the US. On Wednesday, the country's main stock indexes fell, Reuters reported, on signs that the country is going to see anemic growth and an escalation of the tariff war launched by US President Donald Trump. Investor confidence is very weak. There's too much uncertainty around the trade war, Yang Hongsum, Shanghai-based analyst at investment consultancy Shandong Shengwang, told the news agency. While Trump scored initial gains in the tariff war, his Chinese counterpart Xi Jinping is facing the heat. With China's economy now evidencing strain under U.S. tariffs, and the U.S. economy booming, it's Xi who finds himself in a surprisingly weak position, Brian Brenberg of the King's College in Manhattan wrote in Newsweek. Whichever way the trade war is going to play out, the dominant feeling in the White House is that it is winning the battle against the dragon. How will China hit back? With both the countries targeting more of each other's goods, the global trade could soon feel the negative impact. However, with its economy slowing down and stock markets faltering, there's probably a different route though which China can hit back at the US. And that's by hitting the greenback, according to an analyst. Alastair MacLeod, head of research at Gold Money, says that China is well placed to challenge and upturn the hegemony of the US dollar on a global scale. China has long nursed the ambition to create an alternative to the US dollar as the currency for cross-border trade. MacLeod told Russia Today that China could make this happen at least inside the Asia region in the near future. And this can materialize through the gold route, according to MacLeod. He says that Beijing has been accumulating gold for a long time with a view to backing up renminbi. According to him, China has much more gold than the official figure of 1,842 tons. The actual Chinese gold reserve could amount to around 20,000 tons, he says. If China begins to back the yuan with its gold reserves, it could kill the US dollar, the expert says. China launched its yuan-denominated oil futures contract in March this year, prompting some analysts to predict the emergence of the petryuan as an alternative for petrodollar. This could be a death blow for an already weakening US dollar, and the rise of the yuan as the dominant world currency, oilprice.com said in a report at that time, citing analysts. No one knows for sure if China has 20,000 tons of gold in reserves. But if indeed it has that deep a gold reserve, Beijing can take on the US dollar by using gold for international trade. Trade war will then take a different hue, and sanctions founded on geopolitical issues would have less impact. It has been reported that Russia accelerated its bullion buying around a decade ago, keeping in mind the fact that Moscow will have to plunge into a battle against the dollar dominance at some point. China defies Trump, rejects U.S. request to halt Iran crude imports. Though no shocker as we predicted previously, China has refused to cut Iranian oil imports at the United States' request in a severe blow to White House efforts to intensify pressure and economically isolate the Islamic Republic after the U.S. withdrawal from the 2015 nuclear deal. However, Beijing has reportedly agreed not to accelerate purchases. China, itself a target of ratcheting U.S. economic pressure, especially after Wednesday's shock news that President Trump may impose a 25% tariff on $200 billion worth of Chinese goods, remains the world's top crude importer and is Iran's top buyer. Bloomberg reported overnight, citing two officials familiar with the negotiations, that limited concessions have been made. However, Beijing has, agreed not to ramp up purchases of Iranian crude, according to the officials, who asked not to be identified because discussions with China and other countries continue. That would ease concerns that China would work to undermine U.S. efforts to isolate the Islamic Republic by purchasing excess oil. China has long been on record as opposing unilateral sanctions and further, according to Bloomberg, accounted for 35% of Iranian exports last month, based on ship tracking data. Meanwhile, Iran's foreign minister welcomed the news. The role of China in the implementation of JCPOA, in achieving JCPOA, and now in sustaining JCPOA, will be pivotal, Mohammad Javad Zarif said, according to Reuters. The Trump White House currently has teams of negotiators around the world pressuring European and other capitals to cut off trade with Iran, largely unsuccessful to date in an attempt to cut its oil exports to zero by November 4. This has been accompanied by the threat of sanctions for those who don't comply with U.S. demands to show significant progress in reducing Iranian oil purchases. Bloomberg reports that a U.S. team led by Francis Fannon, the Assistant Secretary of State for the Bureau of Energy Resources, recently visited China to discuss sanctions, confirmed by a State Department spokesman. Crucially, it is as yet unclear how severe a toll this will take on the global oil market. As Bloomberg discusses the variables and unknowns at play, the oil market has been speculating about how much of Iran's exports could be eroded by the U.S. sanctions, with analysts from BMI Research to Mizuho Securities predicting that China might boost its imports of cheap supplies from the state and offset cuts by other nations. Countries including South Korea and Japan are reducing purchases from OPEC's third-largest producer before the deadline to avoid the risk of buyers losing access to the U.S. financial system. The Organization of Petroleum Exporting Countries, led by Saudi Arabia, has pledged to fill any supply gaps in the market after Trump's complaints. That's helped limit a rally in global benchmark Brent crude, which is trading near $73 a barrel after falling 6.5% last month. The London marker is still up about 40% from a year earlier. Saudi Arabia, for geopolitical reasons, remains a close American oil partner in lobbying for global isolation of Iran at a moment when Iran's military has threatened to block all regional exports from the Persian Gulf, initiating war games this week near the vital Strait of Hormuz, prompting the Pentagon to deploy additional U.S. warships to the area. Meanwhile, Commerce Secretary Wilbur Ross told Fox Business Network on Thursday that there's more pain ahead for Beijing while also attempting to calm fears of potential blowback on U.S. consumers and businesses, assuring the public, it's not something that's going to be cataclysmic. We have to create a situation where it's more painful for them to continue their bad practices than it is to reform, Ross said of ratcheting up the pressure on China and in defense of the president's escalatory rhetoric on tariffs. The reason for the tariffs to begin with was to try and convince the Chinese to modify their behavior. Instead, they have been retaliating. So the president now feels that it's potentially time to put more pressure on, in order to modify their behavior, he said. Ross tried to calm fears further by saying Wednesday's announcement of potentially raising planned tariffs on $200 billion of Chinese imports from 10% to 25% would only amount to $50 billion, according to him, a negligible fraction of the Chinese economy. But the Chinese aren't seeing it that way, as on Thursday Chinese Foreign Minister Wang Yi slammed talk of possible 25% tariffs. Instead of achieving one's own goal by doing this, we believe it will only hurt one's own interests, he told reporters at a press conference in Singapore. He continued, 60% of Chinese exports to the U.S. are actually made by foreign companies, including American firms in China. Is the U.S. trying to put tariffs on its own companies? For Chinese exports to the U.S., many of them are no longer produced in the U.S. itself. Is the U.S. administration trying to raise the living cost of its own consumers? The Chinese FM said. FM Wang Yi called for cooler heads to prevail, while China is ready to talk to anyone ready to talk to us, including the U.S., This kind of dialogue has to take place on the basis of mutual respect and equality, he concluded. While as much as 2.3 million barrels a day of crude from the Persian Gulf stayed at risk for Trump's sanctions, the White House has now, as predicted, gotten the door slammed by China, while India or Turkey have already hinted they would defy Trump and keep importing Iranian oil. Together three nations make up about 60% of the Persian Gulf states' exports. While next steps remain unclear, the potential outcome for the U.S. isn't, should China fully pivot away from U.S. exports and replace them with Iranian product, the U.S. trade deficit will resume rising, further adding to the pressure of what is Trump's biggest economic hurdle, the double U.S. deficits. The flip side is that since less Iranian oil exports will go unused, it may provide a solace to the U.S. consumer facing the highest gas prices in 4 years. However, if the ongoing pipeline bottleneck in the Permian is not resolved soon, said solace will prove to be short-lived.